Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Well, headlines chase the S&P 500 performance and the NASDAQ. These actually the TSX, of course, it's quietly outpaced both this year. And according to our next guest, that strength comes as pockets of the global market, particularly from AI, look increasingly frothy. Lots of different words for it these days. Are investors chasing growth that may not pay off even for years? And could Canadian large caps offer better value? Joining us here today to give his final call on the year, ultimately, including where he is seeking opportunity for 2026 and where 2025 has taken him, is portfolio manager Dan Dupont. Welcome, Dan. Great to see you. How are you today?
Good to see you too. I'm doing very well, thank you.
Great. And we'll invite everyone to send their questions in for Dan over the next 30 minutes or so. Dan, let's begin with your approach is value. We've talked to you many times. I think most investors know that. At a moment where it appears people are saying the greatest risk is AI, a bubble. I don't know if you agree with that or not, but that seems to be what's out there. What do investors need to know about your fund, if that is the dangling risk out there?
Yeah, so if you're trying to decide whether I'm value or growth, I'm obviously more on the value end of the spectrum, but what I am mostly is a downside protection-oriented investor. And so I'm not trying to make any huge predictions, but I am staying away from things that are a bit frothy or too expensive for my taste as I go around the world, because Canadian Large Cap Fund is allowed up to 49% foreign content. And I do tend to take advantage of that flexibility and go to where the opportunities are around the world. And they've changed a lot over the last 15 years. But yeah, obviously when you look at, just the MAG 7 specifically, in aggregate, their free cash flow yield adjusted for stock-based compensation is around 1.3%. That is obviously not a very attractive type of multiple for me. I would probably be more interested if they were on like a 4% free cash flow yield. I mean, I owned Microsoft in 2011 when it was 10 times earnings.
Wow.
So obviously that was a different world. But yeah, things change and we go where the opportunities are. But I try to protect capital first and foremost. Back to your point on growth, I think the last several years have shown a lot of strength in growth in large cap in US. So US versus the rest, growth versus value, large versus small. So I think when we do a bottom-up type of analysis, we can see that small mid-cap firms around the world are a little bit cheaper, and certainly value-oriented and more defensive sectors too are a bit cheaper because nobody's expecting any recession anymore. Investors are feeling pretty good about themselves. So yes, there's a lot of froth in the large cap growthy US area specifically. But outside of that, obviously it's getting a little tougher as everything has done pretty well this year. It's tougher to find ideas to populate the fund.
Okay, well, interesting. There were a lot of ideas to populate the fund earlier this year. And I remember you have told us a little bit about what April sort of presented as an opportunity. This was the tariff discussion. I'm actually going to move on to ask you if tariffs are loosened or taken off in certain ways where there might be some value. But let's begin with going back to April and what it took you through in terms of opportunities. I mean, the market obviously bottomed on the tariff announcements.
So the way I invest money is to let the market come to us. And the process over the last 15 years has kind of allowed us to do that very, very well at this point. So we can be very patient. And then when volatility arises, we can take advantage of that volatility by deploying capital in more volatile sectors, by using either a little bit of cash that we have or arbitrage investments, companies that are being acquired. Those are very, very low volatility and obviously slightly less returns expected than a typical stock. But when you're waiting for opportunities, it's a great place to be. So we sold a lot of those down 1% in the first week of April to buy stocks that were down 25, 30.
Wow.
So that volatility, that uncertainty created a lot of opportunities for us. And so this year was kind of fun from that perspective. We had a bout of volatility that created the opportunity for us to plant the seeds of future performance in a lot of securities. Unfortunately, fortunately for me, in a way, fortunately and unfortunately, things moved quickly. So we made a lot of money in a lot of these purchases. And then we had to move on from a lot of these buys and we had to change the portfolio to become a little bit more defensive as, those were the stocks that were cheap. So we've zigged when the market was zagging, quite defensive January, February, March, more aggressively positioned April, May. And since then, the market has just forced us to harvest a lot of positions such that at this point, end of 25, looking into 26, we have a lot of defensiveness in the fund. We're basically the most defensively positioned we've ever been in the last 15 years, slightly more than early this year, slightly more than like Jan 2020, slightly more than the fall of 18. It's an environment where it's been difficult to find, more and more difficult to find great investment ideas. Whereas, a year ago, much easier, mostly emerging markets, Europe, Asia. But we'll see what the future holds.
Well, and it's interesting. Things move quickly in those sort of small moments. You've mentioned Europe in the past and what that's represented, and again, that may have been a year ago story for you. But talk us through a little bit about what's in the fund. I'm guessing staples are fairly largely positioned there. Well, I know they are because we take a look at that. But is that around the world? Is that particularly geographic, or is that a global position really?
It's all done bottom up, right? So I get 3 packages a day, and I talk to companies. The 3 packages from Americas, Europe, and Asia from our internal analysts, meet with companies, talk to analysts. And so it's all coming from a bottom up perspective. But I would say it does make sense from kind of a top down perspective as well, that it's very small in the US right now. Some opportunities are getting closer to a price I want to pay. So, we have a K-shaped type economy in the US. Some sectors are getting pummeled more than others, and so getting closer to buy prices. But I'd say, if you take the US compared to 12 years ago, I was heavily invested in the US, and now the core positions are 2% of the fund. The US has done so well. It's become a place where everybody wants to be. It's 70% of the overall MSCI world, or the overall stock market in the world, if you will. So it has brought me to Europe. The other point is, you're absolutely correct. There's more staples. There's more defensive names, maybe a bit of healthcare, because everybody feels really safe about the economy. They feel really good about themselves and about investing in general. They don't see a lot of risks. One of the excellent points about that is that financials globally have gone up massively in the last year. When you have entities levered 20 to 1, like banks in Europe and Asia, going up 50 to 100% in a year, it does mean people are feeling pretty good. So I think that's the environment we're in. It forces us into areas that are being a bit forgotten because of this, of all of these things happening. So what's really cheap? Mostly staples, a bit of healthcare, a little bit of other idiosyncratic ideas. But Europe is over 20% of Canadian large cap right now, and probably will stay for a little bit.
And tell us about whether it is cheaper still. I mean, this is the question. It was that, but it got such an upswing through much of this year that certain parts of Europe, the European trade or the investment thesis, actually are no longer as cheap as they were, which would not be attractive to you. So which parts are still cheap enough to be attractive across Europe? Maybe they're idiosyncratic, or maybe they're sectoral. But
they're a bit sectoral, so good question. We've seen financials do really, really well in Europe. They were up massively. Discretionary things that were more related to defense, they've done quite well. We've made money in Canadian large cap in a chemical company in Germany, and we made a lot of money in tobacco companies in the UK. But outside of that, staples versus the rest, just like in the US, has done pretty badly. People are, again, feeling like there's not going to be any recession anytime soon. We've also had specific problems in spirits, because tobacco did quite well, but spirits still has that overhang from COVID, still has that perception that people drink a whole lot less, when in fact the numbers are kind of, they're really not that bad at all. In fact, you could actually say that, alcohol consumption is way, way better than the average person thinks.
I mean, these are name brands, for instance. These are name brands that are owned.
Well, the names that you can see in the portfolio right now, like the Diageos, the Pernod Ricards, Rémy Cointreau, so they're really large, well-known. There's let's say 5 companies that are practically all based in Europe that control the overall spirits market in the world, that sell, everything the same in Tokyo and London and Miami. So this is a great place to be for us. It's done really, really well. There's a new growth story about, nicotine pouches, but we're still keeping our head down. We'll see where the opportunities come from, but we're always open to new ideas. I just bought a new cyclical name in the US recently, a small position, but it might surprise a few people when they see it in the holdings. But the whole story kind of works where farming has been under a really big depression, or I guess a solid recession in the US. Fertilizers have been hit pretty hard, but also farm equipment. So that's an area I've been looking at. Housing has been really tough. movement of goods has been really tough. So slowly but surely, some of these stocks are getting closer to a buy point.
It's really interesting. And you often invest in sort of the extremities, like where things go extreme in one way or the other. I mean, that's where the opportunities often lie. Tell us a little bit about what AI valuations say to you, and are they an extreme case? I'm guessing we're more in the non-profitable tech side than some of the big names, but what do you see there in terms of an extremity?
Well, I do manage a long-short product, so I do have to look at the extremes. So I am getting, I think, pretty good at figuring out what's going on at the very cheap end and the very expensive end of the market. And having gone through, a little bit of 2000 and then 2021, and right now, I would say this is probably the best shorting environment, to put it in a positive light. So it's the best shorting environment, meaning it's the most egregiously overpriced extreme end of the market we've ever seen. 2021 had a lot of software. We made a lot of money on the short side there. Marijuana stocks, electric cars. And the new area of exaggeration now is around AI and or cryptocurrencies and anything that's related to that. There's also some new financials companies that are being they're being bought by people who they haven't been through a full cycle. They really resemble the new innovations of '07, but in new sectors. You can currently finance the delivery of a burrito to your house in 8 installments, right? And that's seen as financial. And then those are they're securitized after. These receivables are then securitized by these companies. I mean, that's where we are, right? These people are just really excited about the future. And that's pretty typical in investing. We've seen a lot of these iterations in the past. I mean, whenever, when Elon Musk started talking about full self-driving, the following year, insurance companies had to defend themselves that they were not going to be disappearing in the next 5 years. Because everybody thought, well, cars are going to drive themselves. There's going to be 0 accidents left in North America within 2 years, because Elon Musk is always right. And therefore, insurance companies are going to be absolutely useless. And so that was the discussion for a while. And then with the advent of electric cars, we had Couche-Tard having to defend 50 minutes of every hour meeting that, yes, there will still be cars going to, people are going to keep going to their convenience stores to buy cigarettes, even though they don't need gasoline anymore. That's always it's always the case. When I started in the industry, there was a company that was promising, space elevators where they would shoot products in the air, and then it would completely destroy the trucking industry because, stuff would be moving without gravity through the sky. I mean, and people actually believe those things because that was a publicly traded company with a real market cap. So I think that's kind of where we are. There's a lot of promises, not a lot of success yet, and it's going to have to happen quickly because on the flip side of AI, we own some companies. I own a French company that does back office, call centers, and right now they're doing quite well. People think it's going to be devastating for the next 2-3 years, but I am looking where there's a lot of pressure where investors are just becoming a little too nervous to hold stocks that are under pressure. So maybe we do a bit more work, maybe we know the company's a bit better, and we can figure out things a little bit more.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
You mentioned financials earlier. It's been an incredible year in a lot of different ways, and we have lots of reasons why, if rates go even lower in the United States, that could march further and so on. What are your concerns about financials? Maybe is it just that valuations have gone up and it's ridden the market, or why is it an area that you're just a little bit cooler on?
Well, there's nothing specific that worries me because I covered banks in '07, '08, and I know that the real cracks, you can't really see them in advance. The commercial paper market problem at National Bank in '07, nobody could really have predicted. CIBC having $60 billion of US subprime exposure that basically rendered the bank insolvent, which nobody seems to accept in Canada, but they were probably going to lose around $5 billion in a quarter with a book value of 10. BMO with their SIV, I mean, there were problems pretty much everywhere. They were just very difficult to figure out. But when the tide goes out, that's when problems pop up. And in Canada, who knows where they're going to come from? But real estate's been a place where banks have lent a lot of money, and then real estate is very expensive relative to the economy, household income. So there is risk there. In the more general way, I would say globally, one of the risks from financials would be in the U.S., where the U.S. banking system is incredibly strong. It's been much more regulated over time since the '08 crisis, and so they're incredibly robust. The balance sheets are amazing. The problem is there's always some regulatory arbitrage that's being done in the market. In '07, it was AIG, which was an insurance company. It was not regulated as a bank. Every bank used it as a place to securitize or to basically offload a lot of mortgage risk, and that blew up. Look at what's happening today. You have banks who are not lending directly to small mid-cap companies around the world, or lending to private equity firms who then turn around and lend to smaller companies because there's regulatory restrictions there. There's a CEO of a very large bank recently that said it was 6 times more expensive in terms of capital to lend directly to the small firms than it is to the private equity companies. So
just because of regulation.
Just because of regulation,
Right.
It doesn't always make sense. Did it make sense that banks could offload the risk to AIG in '07? Not really. Does it make sense that an embedded insurance company inside of a private equity firm is regulated differently than a typical insurance company? I mean, that's one of the 2 risks. I basically cornered the CEO of Goldman Sachs last year after a meeting where I asked him, what are the 2 biggest risks in your view going forward about, in the financial system? And that was one of the 2. It's embedded insurance companies inside of private equity firms. The other risk he came up with was the concentration in trading in equities that's done by non-market makers, which means that if there is ever a giant amount of spike in volatility, nobody would want to trade because nobody's forced to trade. That's an interesting one, and it's true that everything's become high frequency trading. Blocks are more difficult to come by. So anyway, there's a lot of risks out there, and we haven't seen any spike in corporate spreads in 15 years. So we'll see. So like we did in April, when volatility comes up, you sell those down 1% to buy stocks down 30. And it's a really difficult thing to do in the moment, in the fog of war. But I found out that I have an ability to do that very easily. I have a lot of fun doing that, actually.
And it appears to be a period of consolidation across a few different industries, actually. I mean, we're waking up to the Monday mergers all over the place.
Absolutely. Private equity still has a lot of money to deploy because these funds that they raised in 2020 and 2021, they're 6, 7, 8-year products, so they need to deploy the capital. The more time goes by, if they want to earn their fees, they need to buy companies. So they buy smaller, mid-cap, publicly traded companies. There's also a lot of strategic buying in mostly healthcare these days. So, very large healthcare companies are buying companies that are effectively one molecule or one new product coming around that they want to add to their portfolio. So, yeah, there is plenty. We own a very diversified portfolio of arbitrage positions now. We've gone from 0 the first week of April because we were fully invested. And now that we've kind of called what we own and have had difficulty finding new ideas, it's out of the dozens of deals out there, we own 30.
Wow.
And in the last 2 years plus, we haven't had one that did not work out.
Where else around the world? You mentioned EM at the beginning of the discussion. Is EM still of interest? Does EM actually benefit from AI as well? I mean, a call center is one example, but you could probably go into lots of different companies around the world that will use and deploy.
A lot of the market around the world has revalued in the last year. I would say it's a lot less interesting for me, mostly in large cap land, whether it's in China or Brazil or South Korea or Japan. I'd say what is left that is really interesting, in my view, is a little bit more difficult for me to invest in. It's small, mid Europe and mostly small, but small, mid Japan. So, Asia, but mostly Japan. I mean, the yen's going down pretty much every day these days. And so that's great for exporters, which are mostly giant companies. They're mega caps. Whereas, the small mid-cap companies in Japan that don't export are being pummeled every day by this devaluation of the yen. And so, that's an interesting area. So
it's interesting. So those parts of the world at the moment are less of interest. Doesn't mean you're not always looking at them, but they're just not a big part of the positioning at this stage. Take us to Canada. So large cap Canada, most of the names, I think most people joining you here today know the spectrum and the universe. Are these sector specific again? Are you looking at staples? Are you looking at quite defensively positioned here in Canada?
Well, it's always bottom up, and so this year we made a lot of money in idiosyncratic ideas. One of them was financial. We made a lot of money in TD, which was our only bank holding at the beginning of 25. We bought a little bit of Scotia at the bottom in April, which may or may not show up in the latest holdings. And so, ideas like Saputo, just staples, our core holdings, which we hold for a long, long time, hopefully forever, have done decently well. We've owned Metro for 15 years, great management team, compounds really well, good balance sheet in a competitive industry where it's difficult for competitors to come in. So that's a great place. We've owned Couche-Tard for a long time. We've also had to let go of some firms that did really, really well that been there for years, but they've got more than fully priced. So, TMX Group disappeared from the holdings, Fairfax disappeared from the holdings. It's a bit, heartbreaking to see them go, but when the market kind of lets you, sell them at a decent premium to what they're valued, in my opinion, then that's what we have to do and rotate into new ideas for the next year or two or three, which I think, again, will probably surprise people. You never make money where people expect it.
We started off with sort of the market itself, ultimately how investors might want to look at your fund given what's going on in the market right now, the downside capture side of it and the sleep at night side of it. I think Charles Denis, your colleague, was speaking to you earlier about this, whether you're sort of optimistic about markets, whether you're less optimistic about markets, your fund tends to help investors stay in. And I wonder if you can just go through the downside capture, again, for moments where things like April happen.
Yeah, that's been the process from the beginning. It's been 15 years. If anything, I've improved slightly my implementation of the process because my personality obviously is one of a very defensive, very value-oriented. So yes, the downside capture has always been important. And it's been basically second nature for me. I've predicted, 12 of the last 2 recessions, as I like to say. I mean, I've been probably a little bit more, much more bearish than the average investor. But that being said, I've tried to improve slightly. We buy slightly higher quality companies than we did 15 years ago, or, higher quality companies. We've owned Dollarama. And that's the best example for me of me getting a little bit higher on the valuation spectrum and on the quality spectrum, so that we can actually have more ideas to populate the fund. But yeah, the downside has always been kind of second nature for me, and bouts of volatility are very beneficial for us because people tend to panic a little bit. There's forced sellers, and we are the first call, and that's been true more and more every year where. On days like April 4th, the first place people call with big blocks for sale is us. It's Canadian large cap and the derivative funds around it. And so that's very beneficial for us. Our cost of trading is as low as can be. We're basically the lowest of the Fidelity complex. Of course, the process kind of aligns with that. If I was a momentum investor, I couldn't obviously not trade for such low cost, but the fact that we let people call us as opposed to calling them, we let blocks come to us or demand come for blocks that we own. So we're patient, but every basis point counts. We make it count every day. The traders are very, very aligned with that. So, we have a very, very well-oiled machine here to protect well and to deploy quickly when volatility arrives. Like I said earlier, when the fog of war comes in, you can't be hesitant. You have to plant the seeds of future performance. That's when the opportunities are the greatest.
Fantastic to speak with you, Dan, and wish you all the very best for the holidays. Thanks for sharing where you're at and your knowledge and insight of the markets. All the best.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.